Investing plays a crucial role in wealth accumulation for individuals and institutions alike. Among the plethora of investment options available, stocks and bonds stand out as two of the most prominent financial instruments. While both serve the fundamental purpose of generating returns, they possess distinct characteristics that appeal to different types of investors. This video aims to compare and contrast stocks and bonds, outlining their definitions, risk and return profiles, market behavior, and implications for investment strategies. Stocks, often referred to as equities, represent ownership in a company. When an investor purchases stock, they buy a share of the company's assets and earnings. Ownership of stocks generally comes with voting rights and entitles shareholders to a portion of the company's profits, typically distributed as dividends. Stocks are categorized into various types, such as common and preferred stocks, each differing in terms of dividends, voting rights, and hierarchy during liquidation. The allure of stocks lies in their potential for substantial capital appreciation as companies grow and prosper, often yielding significant returns over time. On the other hand, bonds are considered fixed-income securities that represent a loan made by the investor to a borrower, usually a corporation or government. When an investor buys a bond, they are essentially lending money in return for periodic interest payments, known as coupon payments, and the return of the bond's face value upon maturity. Unlike stocks, which offer ownership stakes and potential high returns, bonds are predicated on the promise of fixed interest payments, which makes them generally less risky. These fixed payments provide a layer of stability, attracting risk-averse investors or those seeking reliable income streams. Risk is an integral part of any investment consideration, and stocks and bonds exhibit markedly different risk profiles. Stocks are inherently more volatile and subject to price fluctuations driven by market conditions, company performance, and broader economic factors. This volatility can result in substantial gains, but it can also lead to significant losses. In contrast, bonds carry lower risk levels, particularly government bonds, considered to be risk-free with government backing. However, bonds are not without their risks. Changes in interest rates can adversely affect bond prices, leading to potential losses for investors. Thus, understanding these risk differences is critical for investors when constructing their portfolios. Another significant difference between stocks and bonds lies in their market behavior and the factors that influence their prices. Stock prices are influenced by various elements, including company earnings, market sentiment, economic indicators, and geopolitical events. Investor perception plays a vital role in stock price movements, as positive news can drive prices up, while negative news can catalyze declines. Conversely, bond prices are primarily influenced by interest rates and credit ratings. When interest rates rise, existing bond prices typically fall since new bonds are issued at higher yields, making older bonds less attractive. Moreover, the creditworthiness of the issuing entity can impact bond prices, with higher-rated bonds generally exhibiting lower yields and risk compared to lower-rated bonds or junk bonds. In terms of liquidity, stocks generally offer greater flexibility than bonds. The stock market is larger and more active, allowing investors to buy and sell shares more readily. This liquidity means that investors can quickly convert their stock holdings into cash if necessary. Bonds, especially those issued by smaller corporations or municipalities, can be less liquid, making it more challenging to resell them without incurring losses. However, government bonds typically enjoy higher liquidity due to their widespread acceptance and demand. The investment strategies surrounding stocks and bonds can also highlight their differences. Equity investors often seek long-term growth, employing strategies such as value investing, growth investing, or dividend investing. These strategies focus on selecting stocks with the potential for significant capital appreciation or consistent dividend payouts. Alternatively, bond investors often prioritize income stability and capital preservation. They may employ strategies such as laddering, where bonds are purchased with staggered maturities to manage interest rate risk. The realm of investment offers a plethora of options, among which stocks and bonds are two of the most prominent. These financial instruments serve as essential vehicles for wealth accumulation, yet they embody distinct characteristics, risks, and rewards. Understanding the fundamental differences between stocks and bonds is crucial for investors seeking to align their financial strategies with their risk tolerance and investment goals. They will elucidate the key differences between stocks and bonds, exploring their inherent risks, potential returns, liquidity, and the overall impact on a diversified investment portfolio. At the core of their fundamental nature, stocks represent ownership in a company, whereas bonds are essentially loans made by investors to borrowers, typically corporations or governments. When an individual purchases a stock, they acquire a share of the company, which entitles them to a portion of the profits and voting rights in corporate governance. Conversely, when an investor buys a bond, they are lending money to the issuer in exchange for periodic interest payments and the return of the principal amount upon maturity. This distinction is pivotal, as it shapes the investor's relationship with the asset and defines the potential for returns. Risk is an inherent component of any investment, and stocks and bonds exhibit varying degrees of risk exposure. Stocks are often considered riskier investments due to their susceptibility to market volatility and economic fluctuations. The value of a stock can dramatically rise or fall based on a myriad of factors, including company performance, market sentiment, and broader economic indicators. In contrast, bonds are generally perceived as safer investments, particularly government bonds, which are backed by the full faith and credit of the issuing entity. However, bonds are not devoid of risk. Interest rate fluctuations, credit risk, and inflation can erode their value, and investors may face the possibility of default if the issuer encounters financial difficulties. The potential returns associated with stocks and bonds further illustrate their contrasting investment profiles. Historically, stocks have yielded higher returns over the long term compared to bonds. This is largely attributable to the growth potential of companies, which can lead to capital appreciation and dividends for shareholders. On the other hand, bonds typically offer lower but more stable returns in the form of fixed interest payments. For conservative investors or those seeking to preserve capital, bonds may provide a more appealing option, particularly in uncertain economic climates. Thus, the choice between stocks and bonds often hinges on an investor's appetite for risk and their long-term financial objectives. Liquidity, the ease with which an asset can be converted into cash without significantly affecting its price, is another critical factor in the stocks versus bonds debate. Stocks are generally more liquid than bonds, as they are traded on major exchanges with a vast pool of buyers and sellers. This liquidity allows investors to quickly enter or exit positions, making stocks an attractive choice for those who prioritize flexibility in their investment strategy. In contrast, while many bonds can also be traded in secondary markets, certain types, such as municipal or corporate bonds, may not be as readily tradable. This lack of liquidity can pose challenges for investors who may need to access their capital swiftly. In the context of a diversified investment portfolio, both stocks and bonds play integral roles in balancing risk and return. A well-structured portfolio often incorporates a mix of stocks and bonds tailored to the investor's financial goals, risk tolerance, and investment horizon. During periods of economic growth, stocks may outperform bonds, enhancing overall portfolio returns. Conversely, in bearish markets, bonds can provide stability and preserve capital, thereby offsetting potential losses in equity holdings. Hence, the optimal allocation between stocks and bonds is contingent upon an investor's unique circumstances, necessitating careful consideration and strategic planning. Comparison between stocks and bonds reveals significant differences in their nature, risk profiles, potential returns, liquidity, and roles within an investment portfolio. While stocks offer the allure of higher returns and ownership in a company, they come with heightened risk and volatility. Bonds, on the other hand, provide a more stable income stream with lower risk, making them suitable for conservative investors. Ultimately, a balanced investment strategy that incorporates both asset classes can enhance an investor's potential for growth while mitigating risk, underscoring the importance of understanding these two fundamental components of the financial landscape. Furthermore, during economic downturns, the relationship between stocks and bonds can shift dramatically. Stocks may underperform during recessionary periods due to declining corporate profits and investor apprehension. In contrast, bonds, particularly government bonds, can serve as a safe haven for investors seeking to reduce portfolio volatility and risk exposure. The inverse relationship between stocks and bonds can be leveraged in asset allocation strategies, balancing risk and return by diversifying across asset classes. Additionally, taxation plays an essential role in the comparison between stocks and bonds. Capital gains from stock sales are typically subjected to different tax rates based on the holding period. Thanks for watching. Capital gains generally. If you found this helpful, don't forget to like, subscribe, and hit the bell so you never miss a money tip. Drop a comment below with your thoughts or questions. I'd love to hear from you. Until next time, stay smart, stay savvy, and keep building your financial future.